Welcome to this explainer. Today, we're putting Hanmi Financial right on the examination table for a full financial physical. We are running a structured, totally data-driven checkup based purely on the hard metrics from their Q1 2026 results. So, is this specialized regional bank fundamentally healthy, or are there some underlying risks we need to talk about? Let's find out. Here's our roadmap for today's physical. First, we'll meet Hanmi Financial. Second, we'll break down those Q1 2026 earnings. Third, we'll look at the competitive landscape. Fourth, we'll review their dividend track record. And finally, we'll get Wall Street's verdict. All right, Section 1, meet Hanmi Financial. Let's look at their banking moat and the basics. So, founded back in 1982 in Los Angeles, Hanmi has this incredible true strength, their banking moat. And it's all about their deep cultural and linguistic ties to the Korean-American community. This isn't just your run-of-the-mill generic bank. They really cater to a very specific niche. They've got a network of 32 full-service branches spread across states like California, Texas, and Illinois. And they absolutely specialize in commercial, SBA, and trade finance lending for mid-sized businesses. This targeted focus, it builds these incredibly sticky long-term relationships that really help insulate them from the broader competition. And get this, by the end of Q1 2026, Hanmi was sitting on total assets of $7.83 billion. They are definitely not a microcap operation. Having this kind of massive scale provides a highly stable, powerful platform for sustainable long-term growth. Moving right along to Section 2, the Q1 2026 earnings breakdown. It's time for a vital signs check. Now, if we compare Q1 2026 directly against the previous quarter, we're seeing a really positive upward trajectory across the board. Net income, that bumped up from $21.2 to $22.55 million. Earnings per diluted share jumped from 70 cents up to 75 cents. And you've got to look at these return metrics. Return on average assets improved to 1.18%, and return on average equity climbed to a very healthy 10.86%. Honestly, these are just strong, undeniable signs of core operational health. Now, a really crucial metric for banks is the efficiency ratio. Basically, you calculate this by dividing non-interest expense by net interest income plus non-interest income. Simply put, a lower ratio means the bank is spending less money to generate a single dollar of revenue. And in Q1, Hanmi improved this metric to a very solid 53.48%, which is down from nearly 55% the previous quarter. So yeah, they are definitely getting leaner. To wrap up this earnings check, total loans sat at $6.55 billion, while deposits actually grew 2% sequentially to hit $6.80 billion. And here's the crucial part. Their net interest margin expanded by 10 basis points to 3.38%. That basically means they're making more money on the spread between what they pay out and what they take in. Plus, non-performing assets fell to just 0.16% of assets. That is a remarkably clean balance sheet, which gives investors a really great margin of safety. Okay, Section 3, the competitive landscape. Let's run a quick regional stress test. First up, let's contrast Hanmi against PCB Bancorp. PCB is quite a bit smaller, holding about $2.5 billion in assets compared to Hanmi's roughly $7.5 billion plus. Really, it comes down to a classic risk-reward trade-off. PCB might offer a cheaper valuation and potentially faster percentage growth, sure, but their lack of scale means they come with significantly higher business and economic risk. Sitting comfortably as the number 2 Korean-American bank, Hanmi's superior scale just offers a much more stable, powerful platform for sustainable expansion. So on a risk-adjusted basis, Hanmi definitely takes the win here. But what happens when we compare Hanmi to a top-tier player like Preferred Bank? Well, this is your classic quality versus value debate. Preferred Bank is a premium institution with just phenomenal profitability. We're talking an ROE over 18% and an efficiency ratio under 35%. Naturally, because of that premium quality, they traded a higher multiple, roughly 9 times earnings and 1.4 times book value. Hanmi, on the other hand, is your deep value play. Trading at a lower multiple, around 7 times earnings and 0.8 times book value, they still offer a really solid 11% ROE. Bottom line, if you want premium quality and profitability at a price, look at Preferred. But if you're an investor strictly focused on low multiples, deep value, and yield, Hanmi is definitely the better choice. Moving right along to Section 4, dividend track record and shareholder returns. 3.4%. Based on their recently declared 28-cent quarterly dividend, Hanmi offers a really bold 3.4% annual dividend yield. Let's be real. In an environment where investors are constantly hunting for reliable income, that is a highly attractive figure for sure.
And this isn't just a flash in the pan. If we trace their annual dividend payouts over the last decade or so, you can see an impressive trajectory. Back in 2013, the annual payout was just 14 cents. Then that climbed to 80 cents by 2017, hit 94 cents in 2022, and reached $1.08 in 2025. This timeline clearly demonstrates that management has a long-term commitment to consistently returning capital to their shareholders.
To keep this analysis highly actionable for you, we've got a major upcoming catalyst right around the corner. Hanmi is set to release their Q2 2026 earnings and host their conference call on July 21, 2026. This is going to be the next major test to see if they can maintain this momentum. We'll be watching particularly closely to see if their net interest margin continues to expand or if deposit costs start catching up to them. And finally, Section 5, Wall Street's verdict. Time for a second opinion. Looking at the current analyst recommendations, the consensus is what I'd call cautiously optimistic. Out of the analysts covering the stock, we currently have 4 hold ratings, 2 buy ratings, and absolutely 0 sell ratings. Basically, Wall Street is saying this is a solid, stable asset, which explains that average hold rating, but there just isn't a massive rush to aggressively accumulate shares right this second. Now, it's also absolutely crucial to look at recent insider activity to give you a fully transparent risk profile. We have seen some moderate selling recently. Matthew Furr sold 3,300 shares at an average of $30.83, and Anthony I. Kim sold 5,333 shares at $30.73. But even with those recent sales, overall insider ownership remains at a very healthy 2.12%. That shows us the folks running the bank still have plenty of skin in the game. So factoring in all that earnings data, their competitive positioning, and the broader market environment, analysts have set a consensus 12-month average price target of $32.10. And with the stock currently hovering right around that $32 mark, it suggests the market believes the stock is currently fairly valued based on its current fundamentals. Well, that brings us to the end of our financial physical, and it leaves us with one final provocative question. Knowing what you know now, the solid Q1 earnings, that strong cultural moat, the reliable 3.4% dividend, but also keeping in mind the trade-offs in quality when compared to those premium peers, at roughly $32 a share, does this deep value regional bank fit into your portfolio? You'll have to weigh the value versus quality trade-off for yourself. Thanks so much for joining me on this explainer, and we will see you next time.